Have you ever noticed how billionaires seem to buy when everyone else is selling? While your coworker is panicking about the stock market crash, Warren Buffett is shopping. While your neighbor is FOMOing into crypto at all-time highs, the wealthy are quietly taking profits. It's not luck. It's not insider information. It's something way more fundamental. Here at Simple Money, I've spent years studying how wealthy people actually think about money. And what I discovered changed everything I thought I knew about building wealth. Today, I'm going to reveal the exact mental frameworks that separate people who build generational wealth from people who stay stuck in the financial hamster wheel. And I promise you, it's not what you think. Here's what's really happening. Most people believe that wealthy people are just better at controlling their emotions, that they're somehow immune to fear and greed, that they've mastered their psychology through sheer willpower. That's completely wrong. Wealthy people feel fear and greed just as intensely as everyone else. The difference isn't in what they feel, it's in how they've trained themselves to respond to those feelings. Think about it this way. Fear and greed are like the gas pedal and brake in your car. Most people are either slamming on the gas or slamming on the brakes. They're all acceleration or all panic. No control, no strategy. Wealthy people? They've learned to use both pedals deliberately. They understand that both emotions contain useful information, but neither emotion should be in the driver's seat. Let me show you exactly how this works. The first framework wealthy people use is what I call the inverted emotion strategy. Here's the concept. Wealthy people have trained themselves to feel excited when everyone else is fearful, and they feel cautious when everyone else is greedy. This sounds simple, but it's brutally difficult to execute. Why? Because humans are wired for social proof. When everyone around you is panicking, your brain screams at you to panic too. When everyone is getting rich on some new investment, your brain tells you you're missing out. But here's what makes this strategy so powerful. The best opportunities almost always appear when they feel the worst. Let me give you a specific example. March 2020. The pandemic just hit. The stock market dropped 30% in 3 weeks. People were liquidating their retirement accounts. Your uncle was sending doom and gloom articles in the family group chat. What did wealthy investors do? They bought aggressively. Not because they weren't afraid, they were terrified. But they'd trained themselves to recognize that extreme fear in the market creates extreme opportunity. The psychology behind this is fascinating. When everyone is selling, prices get pushed way below the actual value of assets. It's like a fire sale at a department store. Except instead of buying discounted sweaters, you're buying discounted pieces of businesses that will likely recover. The person who inverts their emotional response doesn't need to predict the future perfectly. They just need to recognize that crowd psychology creates predictable mispricing. Now here's where it gets interesting. The second framework is what I call emotional preloading. Wealthy people don't just react differently in the moment. They prepare for emotional situations before they happen. Think about a professional athlete. They don't just show up on game day and hope they perform well under pressure. They visualize. They practice high-pressure situations. They mentally rehearse how they'll respond when things get intense. Wealthy people do the same thing with their finances. Before a market crash happens, they've already decided exactly what they'll do. They've written down their buying criteria. They've set aside cash specifically for opportunities. They've mentally rehearsed staying calm while everyone panics. Before a market boom happens, they've already decided their exit strategy. They've determined what percentage of gains triggers profit-taking. They've committed to a plan that prevents them from getting swept up in mania. Here's why this matters so much. In the moment of peak fear or peak greed, your rational brain basically shuts off. You're operating on pure emotion and instinct. If you haven't preloaded your response, you'll do what everyone else does. Panic, sell at the bottom. FOMO, buy at the top. Make decisions you'll regret for years. But if you've already decided what you'll do, you're just executing a plan. No difficult decisions in the heat of the moment. No relying on willpower when your emotions are screaming at you. The third framework might be the most counterintuitive. It's called the boring advantage. Here's what wealthy people understand that most people miss. Getting rich slowly is dramatically easier than getting rich quickly. Think about how backwards this is from what we're taught. Every ad, every influencer, every get-rich scheme promises fast results. 10x your money. Retire in 5 years. Double your income in 6 months. Wealthy people? They're comfortable being bored. They understand that compound interest is boring. Index funds are boring. Paying off debt is boring. Living below your means is boring. But boring wins. Here's the psychology behind why this is so hard. Our brains are wired to seek novelty and excitement. Boring feels like nothing is happening. Like you're missing out. Like you're not making progress. But here's what nobody tells you. Excitement in investing is usually correlated with risk. The more exciting the opportunity feels, the more likely you are to lose money. Wealthy people have trained themselves to find excitement elsewhere in life. They get their dopamine from hobbies, relationships, experiences, not from checking their portfolio every 5 minutes or chasing the latest hot investment. Let me give you a specific scenario. Your friend tells you about some crypto project that's going to moon. It sounds incredible. Revolutionary technology. Celebrity endorsements. Your friend already doubled his money in 3 weeks. Your brain is flooding with FOMO, with greed, with excitement. A wealthy person in this situation feels that same pull. But they've trained themselves to recognize it as a warning sign, not an opportunity signal. They ask themselves boring questions. What's the actual use case? How is this different from the 100 other crypto projects? What percentage of my portfolio can I afford to lose entirely if this goes to zero? Usually the answer is they pass. They stick with their boring strategy, and they sleep well at night. The fourth framework is what I call the zoom out principle. Wealthy people have trained themselves to think in decades, not days. Here's what this means practically. When the market drops 10% this month, most people feel like they're losing. Their account is down. The number got smaller. That feels bad. Wealthy people zoom out. They look at a 10-year chart. They see that 10% dips happen all the time. And every single time in history, patient investors who stayed invested recovered and made money. The same thing happens in reverse with greed. When some investment has gone up 300% in a year, most people see that chart going up and to the right and think it can only continue. Wealthy people zoom out. They look at historical patterns. They recognize that what goes up dramatically usually comes down dramatically. They start getting cautious exactly when everyone else is getting excited. Here's why our brains struggle with this so much. We're wired for short-term survival. Our ancestors needed to react to immediate threats and immediate opportunities. Planning decades ahead wasn't part of the evolutionary equation. But building wealth is a long-term game. The decisions that feel right in the moment are usually wrong for the decade. Wealthy people have trained themselves to disconnect their emotions from short-term price movements. They've trained themselves to care about trajectory, not temporary fluctuations. Think about it this way. If you're driving from New York to California, do you freak out every time you hit a red light? Every time traffic slows down? Every time you have to take a detour? No. Because you're focused on the destination, not every tiny moment of the journey. That's how wealthy people think about their financial journey. Red lights and detours are expected. They're part of the process. They don't change the destination. The fifth framework is what I call strategic discomfort. Here's something that might shock you. Wealthy people have trained themselves to be comfortable being uncomfortable. What does this mean? It means they've learned that the right financial decision usually feels wrong at first. Buying when everyone is fearful feels wrong. It feels like catching a falling knife. Your brain is screaming that you're making a mistake. Not buying when everyone is greedy feels wrong. It feels like you're missing out, like you're the only person not getting rich. Living below your means when you could afford to splurge feels wrong. It feels like you're depriving yourself for no reason. But wealthy people have learned to recognize discomfort as a signal that they're probably doing the right thing. Here's the psychology behind this. Our emotions evolved to keep us safe and accepted by our social group. In the modern financial world, those same emotions often lead us astray. Doing what feels comfortable usually means doing what everyone else is doing. And doing what everyone else is doing means getting average results at best. Wealthy people have trained themselves to lean into the discomfort. Not recklessly, but strategically. They've learned to ask themselves, why does this feel uncomfortable? Is it because I'm taking a stupid risk? Or is it because I'm going against the crowd in a smart way? Let me give you a specific example. Imagine you've saved $30,000. Your friends are buying new cars, taking expensive vacations, upgrading their lifestyles. You're thinking about investing that money instead. But it feels uncomfortable, like you're being cheap, like you're missing out on enjoying your life now. A wealthy person in this situation recognizes that discomfort. but they understand what it really represents. It's not a signal that they're making a mistake. It's social pressure and delayed gratification, discomfort. They choose the strategic discomfort of investing now, because they know that money, invested for 10 years, will buy them way more freedom later than a car or vacation will bring them today. Now here's where things get really interesting. Let me tell you about two people who taught me everything about how these frameworks play out in real life. Let me tell you about Marcus. Marcus is 32 years old. He makes $75,000 a year. Pretty solid income. Marcus considers himself financially savvy. He reads about investing. He follows finance influencers. He knows he should be building wealth. But here's what Marcus does in practice. When the market is doing great and everyone at work is talking about their portfolio gains, Marcus gets excited. He starts checking his investments multiple times a day. He starts thinking about moving money from his boring index funds into something more exciting. When he sees that some tech stock went up 40% in 3 months, he feels that pull, that FOMO. He tells himself he's doing research, but really, he's just looking for permission to chase returns. Then the market crashes. Suddenly, Marcus's portfolio is down 15%. He can't stop checking it. Each time he looks, he feels worse. He starts reading articles about recession, about bear markets, about how this time might be different. The fear builds. Finally, he sells. He tells himself he's being smart, protecting his capital. He'll get back in when things stabilize. But here's what Marcus doesn't realize. He just locked in his losses, and when the market eventually recovers, he'll be sitting on cash, watching from the sidelines, too afraid to buy back in at higher prices. Marcus isn't stupid. He's not lazy. He's just operating on emotions without a framework. He buys when buying feels good because everyone else is making money. He sells when selling feels safe because everyone else is panicking. He's letting his emotions drive every decision. Over 10 years, Marcus will probably earn some returns, but they'll be dramatically less than if he just stayed invested. He'll blame bad luck, bad timing, the market being rigged. But the real problem was never external. It was that he never learned to work with his fear and greed instead of being controlled by them. Now let me tell you about Jennifer. Jennifer is 33 years old. She makes $78,000 a year. Almost the same situation as Marcus, but Jennifer approaches everything differently. Before she even started investing, Jennifer wrote down her plan. Not just what she'd invest in, but how she'd respond emotionally. She wrote down, "When the market drops 10% or more, I will buy more. Not because I'll feel like it, but because historically that's been a good opportunity." She wrote down, "When my portfolio is up 30% in a year, I will rebalance. I will take some profits, even though it will feel like I'm leaving money on the table." She set up automatic investments. Every month, money leaves her checking account and goes into her index funds. She doesn't have to think about it. She doesn't have to feel good about it. It just happens. When the market crashed and her portfolio dropped 15%, Jennifer felt the same fear Marcus felt. Her stomach dropped. She felt the urge to sell, but she didn't ask herself what felt right in the moment. She looked at her plan. Her plan said buy, so she bought. It felt terrible. Her hands were shaking when she transferred extra money to her investment account, but she did it anyway. When the market recovered, Jennifer's portfolio wasn't just back to even, she was up significantly. Because she'd bought more shares when they were on sale. When everyone at work was bragging about their crypto gains and Jennifer felt that familiar FOMO, she didn't fight the feeling. She acknowledged it. She felt it fully. Then she asked herself, "Does this fit my plan? Does this fit my criteria?" It didn't, so she passed. She felt the discomfort of missing out, but she trained herself to be okay with that discomfort. Over 10 years, Jennifer will dramatically outperform Marcus. Not because she's smarter, not because she has better luck, not because she feels less fear or less greed, but because she built a system that works with her emotions instead of relying on willpower to overcome them. Here's what most people don't realize. The difference between Marcus and Jennifer isn't about character. It's about framework. Marcus is trying to use willpower to overcome his emotions in the moment. That's exhausting. It rarely works. It requires him to be perfect under pressure. Jennifer isn't relying on willpower. She's not trying to overcome her emotions. She's acknowledging them, feeling them, and then following her pre-planned system anyway. It's not actually about being fearless or greedless at all. It's about building systems that work even when you're feeling fear and greed intensely. Think about it this way. You can't control whether you feel afraid when you're on a roller coaster, but you can trust that the safety harness will keep you secure regardless of how afraid you feel. Jennifer built financial safety harnesses. Marcus is trying to talk himself into feeling brave while hanging on by his fingernails. The wealthy people who succeed with money aren't the ones with the strongest willpower. They're the ones who've accepted they're human. They'll feel emotions, and they need systems that work anyway. They've stopped trying to eliminate fear and greed. They've started trying to make better decisions despite fear and greed. And here's the thing that might blow your mind. Once you see this pattern, you can't unsee it. Every financial decision you make from here forward, you'll start to notice your emotions. You'll feel that pull toward what's exciting, that fear around what feels risky, and you'll get to ask yourself a different question. Not how do I feel about this, but what does my framework say? What does my plan say? What would the wealthy version of me do? Fear and greed aren't character flaws. They're predictable patterns that can be worked with once you understand them. The question isn't whether you can eliminate these emotions. You can't. You're human. The question is whether you'll build systems that help you make good decisions even when your emotions are screaming at you to do something else. The people who build real wealth aren't superhuman. They've just learned something that most people never learn. Your emotions provide information, but they shouldn't make your decisions. So what's your framework? What's your plan for the next time fear or greed shows up? Because I promise you, they're coming. The only question is whether you'll be ready.